Sometimes a headline tells the whole story. Sometimes a headline is just there to draw you further in. And in this case, this headline is actually just the tip of the iceberg. How Wall Street is treating media stocks differently in 2021. The headline leads you into a story and into all of the data that's being used to tell it, but not the story entirely, or at least not the whole story. Let's take a look at the before and after effects of the AT&T and Discovery merger news and the future that these media companies have with consideration from Wall Street. Here we go.
Ladies and gentlemen, hiss and foes, welcome to the Culture Casino.
It can't be denied that the market focused on the streaming service aspects of all of these companies for the better part of a year. They had to. They were oftentimes the most reliable source of revenue for these media-centric companies. It might have been their only source of revenue at certain points. Even the communications central entities like AT&T and Comcast, they still had to show prowess in their ability to stream media or offer streaming services, etc. And despite their best efforts, they took the occasional hit. Focusing in on AT&T, we should have known that something was going on or was going to change. Many, like myself, were focusing on the slow restructuring of Warner Media by the aptly named Jason Kilar. Now, internally, things were being reshaped in divisions and redundancies were being eliminated, and we talked about that all along the way. This created a very competitive environment within the company, which oftentimes is pretty good, but also one that the industry and the industry insiders and the access media absolutely hated because it was targeting some of their darlings. Now, the moves behind the scenes actually that were happening, we weren't aware of. They were very covert, yet the signs actually were there. In fact, back in March, The Observer, they took a look at how Hollywood's biggest companies stack up on Wall Street in 2021. The article does the predictable rehash of the events of the previous year and all of the framing around the market at that time in order to illustrate a very salient point. They show the 18-month market cap valuation changes for these companies. And when you look at this, you see the difference for all 11 medium conglomerates that they identified. AT&T was the only one of all of these that dropped. Even itty-bitty Lionsgate shot up 38%, which was surprising to me. As highlighted here in the Observer's second major takeaway point, AT&T was the most indebted non-bank corporation in the United States during that time. They also thought that HBO Max wasn't growing quickly enough. They do admit that AT&T took a small hit in spinning off 30% of DirecTV and forming a separately operated entity named DirecTV with TPG, but didn't actually highlight the $1.8 billion windfall that would be applied towards paying down the debt, which I think they probably should have. By the way, did that DirecTV move sound familiar to something that recently happened? Anyway, for some reason, Wall Street had pictured AT&T growing in the streaming segment at a much faster rate than they were able to do or they were planning. And in other words, they failed to match pace with the others. Instead, they plodded along a steady pace that would keep churn manageable over time, while the others actually grew at the expense of, well, future business stability, in my opinion. Looking back at the Variety article, we look at a massive shift in media stocks with the second quarter of 2021, just short of the disclosure of the proposed merger with Discovery. So on May 14th, AT&T was 10% up for the year, and Comcast was up 16%. Also for the year. Juxtapose that with Disney's 2% decline over that same period of time and Netflix's 6% decline in that period of time. In fact, in the case of Netflix, they have fallen short in their subscriber predictions and are viewed as underperforming. At least underperforming compared to its peers of late. I don't know if you can call that company underperforming, but hey, using these metrics, sure. Disney is now being scrutinized as they fell nearly 6 million subscribers short of Q2 projections. Investors are also looking at Disney to show a return to its cash cow core businesses, in particular its theme parks, and they expect that growth to come quickly. Disney has also been set by many analysts lower in the short and mid-term and is still sitting at minus 58% in return to value, which makes it highly overvalued at this point in time, which again, many analysts and myself have been thinking for a while. I also suspect again that monthly Hulu Live TV lost subscribers on the back of the previous quarter's rate increase of $10. I haven't looked into it as of yet, but as I know, or at least I've heard, Hulu Live TV lost 200,000 subscribers, at least versus the previous quarter, from 4 million to 3.8 million. Wow. Disney has likely found what I would think would be the top end of what their subscribers are willing to pay for all of their streaming products, and yet their ARPU has gone down. Of course, we previously discussed that as well. That doesn't bode well for the future for them, which is another reason why Wall Street is looking at Disney to return to normal in all of their other segments. Lots of analysts are starting to arrive at the conclusion that consumers are reaching their tolerance level for paid streaming prices. 2 or 3 services are starting to ring up a pretty hefty price tag, and consumers now have even more options for entertainment as life returns to normal. So, I think that's wise thinking. Wall Street is also now refocusing on these conglomerates, expecting a return to normal with all of their additional segments. And they should. Ironically, Disney has jumped all in on the streaming side of things, direct to consumer is what they call it, and really they should be refocusing on their core cash cows. This may lead to further dips in their stock prices, and as investors and analysts will expect recovery on those cash cows. What's it like to be at odds with the market, Disney? Not a good plan. Finally, I expect, as do many others, that we will see more consolidation of streaming and a return to other forms of entertainment by consumers, as I previously stated. And in the end, only a handful of premium offerings will be the winners in the streaming wars, along with free services that will continue to exist under a commercial AVOD-driven model. I think that's probably it. So, there are my thoughts. What do you think? Do you think Wall Street's change in priorities is a good thing? I do. Do you think we will see more blockbuster mergers of media properties? I also think that as well. I think there are a few that are ripe for that, including MGM, Lionsgate, Sony, and a few others. But, hey, I'm interested in hearing what you have to say, so leave your comments in the area below, and we'll talk about it there. Be sure to support other independent creators here on the platform, as they desperately need your support while they're not being recommended as often by the platform in favor of larger media entities. Go figure. Be sure to subscribe to everybody that you possibly can, support them as much as you can, and be sure to comment and like their videos, because it does help with the algorithm. And as I end this video, as I pretty much end all videos, be sure to take care of yourself, take care of others, wash your hands, of course, because it's good hygiene. And until next time, bye. Hey there, one last quick note before I let you go, and before we make it to the end of this video. I, CultureCasino, have a brand new Teespring store. That's right, you can now go to Teespring, look up CultureCasino, or use the link in the video below, and pick out some handsome and beautiful CultureCasino merchandise with many different designs and styles and colors, many different items. I was actually surprised at all of the things that you could create, and I have some more designs and items on the way here shortly. But, you know, if you want to support the channel in that way, there is some merch. Otherwise, here comes the ending. Thanks for visiting today. Be sure you're subscribed and hit that for alerts.
Yay! Of course, like and share all of the videos that you can, as it helps with the algorithm. Have a great day.